Stephen Thomas coming to you, wow, live on this beautiful Friday, cool afternoon, autumn afternoon in California. Just wanted to say welcome to my very last housing debrief of the year. There will be a forecast, the 2023 forecast that we'll be doing later on, probably sometime in December. But other than that, this is the third season. It's a wrap. Housing Debrief is done. 35th episode. We used to do them 2 episodes per week, and we have done well over 100 episodes so far. Season 3 will be done after today. Thank you for watching and staying tuned. We really appreciate it. And it's all about getting the good information out there. There's nothing like good, solid data and stats to help calibrate your decision making and understanding of the housing market. So let's go ahead and get started here. Of course, I'm inviting everybody to go to YouTube. Please go to YouTube. Please subscribe to our channel. If there's one thing you could do for the housing market, I think, is have people come to the channel. And the best way of doing that is invite other people there. But a great invitation is by subscribing and smashing the like button. The more subscribers and likes that we get, the more the YouTube algorithms love it, and it gets more people to realize the real data and facts out there so they can properly make their decisions. So, we have another update on inflation. So we had CPI last week that I had to bring you, and this week I'm bringing to you one that's not as used as often, but it's definitely something we follow. There's several different inflation metrics that we follow, and this one is PPI. And you could see over here that PPI headline came down quite a bit, and so did the core PPI. And you don't see it once it starts coming down. It doesn't really fluctuate. It definitely has a feeling that we're seeing this lid on inflation and it's slowly going to come down, which by all means, I believe that we're seeing the last of the 7% plus interest rates. There's only one party that can change that, and that is if they go well beyond what their mandate is, and that's the Federal Reserve. But I am excited. I reserve my excitement, though. Of course, these are just another data point. I told you last week it's a data point. Well, this is another data point. When we have a series of data points, we'll see where we are in December, because when they meet, there'll be another CPI release right in the middle of when they're meeting, and that can definitely dictate the direction they're going, most likely up 0.5%. Now, understand that all of these are already baked into long-term interest rates. The 0.5% that's coming probably in December, and then there's going to be 2 quarter-point rises in 2023, and that's what's already baked into the equation. And that's why you have some Federal Reserve people coming out this week saying, wait, we're not done yet. Well, we all know that you're not done. And you can see this is the 10-year Treasury. The appetite of the investor looking at 10-year Treasuries is the same appetite of the investor looking at mortgage-backed securities. So they kind of go hand in hand. When this goes down, interest rates typically go down. When it goes up, interest rates go up. And you can see right here that we have the 10-year Treasury. Where I talked about last week was how it had really risen a lot from the very beginning of this year to where we are today. But there was a big drop last week, and that drop has remained flat since then. This is kind of up for the day, but pretty much from the drop of last week to where we are today, it's almost the same exact level. So even though we had that great inflation read, there wasn't already a change. It's been digested, and this is where everything's at now. We're going to kind of wait and see where we are a month from now. So you can get some fluctuations over the course of now through the next month. If the Federal Reserve is trying to do their best to make this thing go back up and for people to continue to have these higher rates, so it continues to slow things. But the overall economy really is slowing. I really feel that they're a little bit out of touch. The Fed is starting to get a little bit out of touch as to how the markets are really reacting and behaving, and where most likely inflation is headed. So if you look at what's happened with mortgage rates, well, here we are. I'm pointing to it. It's been flat for the last week. 6.65% right now. I think last week when I did this, it was at 6.62%. So, I mean, almost the exact same rate in the last week, very similar to the 10-year Treasury. And the last time we saw something like this was July of 2007. But in the middle of last week, we were looking at rates in the 7s, and the last time we were there was in 2002. So definitely moving the right direction as far as where rates are concerned. And the only entity that can really change and curb everybody's enthusiasm is the Fed. They can't come out really aggressive. I can't imagine that they're going to come out even more aggressive this coming up December when we get another inflation read that's most likely going to be continue to go the direction that the current last week and this week's did, where we're starting to see it ease down. It's not going to be instantaneous, though. You have to understand, it took us a long time to get up to where we are right now as far as where inflation was. So it took us a long time to get there. It's going to come down. It's going to take time. It's not going to drop and sink like a rock. So, and as a matter of fact, all of the different Fed presidents have been coming. He loves getting in front of the camera and telling everybody how he is going to be more aggressive, and he thinks we can see the short-term rate go into the 7s. But you know what? That's not where his dots have been showing where he wants to be in the future. So he's saying a lot of this stuff because he can right now, and he wants to continue to do what he's been doing, and all the different Fed presidents and Jerome Powell coming out and saying that we're going to continue to maintain the course. But that's going to be all good and fine until we actually see larger shifts and cracks in the economy, not just on the housing side of things. So I think they're being a little disingenuous when they go up there and they start talking about they can see the short-term rate getting up to 7%. That kind of spooks everybody. But I'm saying, even though he said that this last week, we didn't really see a change in mortgage rates, nor did we see a change in 10-year treasuries, because we're not people, investors and economists aren't quite buying what he's saying right now. So let's get into luxury cooler, not frozen. So this is luxury in all of Southern California. Each of the different markets kind of has their own individual level of luxury. My personal definition for luxury is the top 10% of the market. Now, there are certain areas along the coast where they say that doesn't even come close to what our average is. Well, you can do the top 10% for certain areas, and of course it's a lot higher. But this is for the entire county. And we'll get into what those percentages are or what those dollar amounts and levels are. But this is where we currently are right now. And if you draw a line across, yeah, we have been higher earlier this year, but you can see how high we are prior to COVID. That is where those little mountains are on the left-hand side in the middle on over. And those mountains are really small compared to the Himalayas of the last few years. So we've definitely been experiencing very, very high level of sales and luxury, and including this year, because this is luxury closed sales. And I know this looks convoluted, but red was last year. Green was 2020. That purple was prior to COVID, 2019. You have to keep that in mind. This is where we were prior to COVID, and this is the red was last year, and earlier this year, the orange, that it was exceeding where we were last year, which was a record-setting year. But you could see where we're at right now, and 2022 is down 4% compared to last year, which was an all-time record year. And this is where we were earlier in the year, but this is where we are right now. We are below 2021 and below the green bar, which is 2020, but it still exceeds the purple line, which is 2019. And that's a lot smaller, but it's been making its way down towards that. As a matter of fact, Los Angeles is 2 million plus. And right now, that's luxury definition, is 2 million plus. And it's right now down 12% compared to last year. And Orange County is at 2 million plus also, and it's down 9% compared to last year. And Riverside is at 800,000 plus. They're up 10% over last year. And San Bernardino's 800,000 plus, and they too are up 24% over last year. Now, I know Riverside and San Bernardino look like they're off the charts, but things have changed recently. They were later to the party as far as the slowdown is concerned, and they are definitely experiencing slower months now versus some of the markets they saw as early as July versus just within the last month or two, September, October. San Diego is at 1.5 million plus, and it is down 26% over last year. So, and last year's record-breaking year, but this is definitely, you can see there's some softness, especially in some of the coastal markets. But I wanted to bring on our sponsor, Alan Mack from Mack Financial Services. He is really good at what he does. He's $1 million plus is what his area of expertise is. Superior luxury residential financing is what he does. And but he still has non-conforming loans above 647,200 is actually considered non-conforming, and you can apply jumbo products to that, which is just a boatload of houses that are available today. And he shops for the lowest mortgage rate, the lowest rate, and gets the best rate in town. That's because he has a network of private and regional banks. He knows the best in these banks because he's been around, and he has he works with high net worth clients as well, and does cash flow analysis, asset depletion. So he knows how to work with them as well to get them a different kind of product. He has a special 2-1 buy down that starts at 3.375%. So that's something else that he's got out there. He's got loads and loads of experience, because experience matters. He's been doing this since 1988, over 100 5-star reviews, his unparalleled knowledge, and he is part of the 5-star professional 2022 market leaders. And he's been in the Forbes December 2022, January 2023 issue that is coming out. He is going to be showcased there. Alan Mack at Mack Financial Services, you can contact him and let him get you the lowest rate, 949-929-1091. That's 949-929-1091. Now, back to, thanks, Alan, for your continued sponsorship as well. But back to the program, luxury has caught a cold. And you can see it in the numbers when it's down year over year, when earlier in the year, it was up way over last year. And it's caught a cold because of Wall Street. And when the financial market is topsy-turvy and people don't really know the exact direction of things, and they're talking about recessions down the road, and recessions impact Wall Street as well, well, that causes luxury to catch a cold as well, because a lot of luxury products are purchased, homes are purchased all cash. They're also they have these special banking relationships that they have, because they have a lot of money in the bank, and a lot of times when they have that they get special rates if they do decide to go down the interest rates. So they're not as vulnerable to these high rates. But the reason why we're having these higher rates is because of what's going on in the economy. So the economy is topsy-turvy, and that's what affects luxury. And as far as luxury is concerned, year-over-year Los Angeles County luxury, the inventory in Los Angeles is at 2,135 homes above 2 million plus. That's up 24% compared to last year. Demand is at 316. That is the number of pending sales, 316 pending sales. That's the last 30 days worth of pending sales activity. So there's 316 that were placed in escrow in the last 30 days. That's down 43% compared to 1 year ago's reading. And the expected market time's at 203 days right now today for 2 million plus. Last year was at 98 days. Now that's soft, but I do want to show, you can see at 203 days, that's kind of up there. 98 days is a pretty fast market, but let me get into some other markets. But I do want you to know that pre-COVID 2019, in November, in the middle of November 2019, pre-COVID, the expected market time for 2 million plus was at 239 days. Now, this is the closest that anybody is even getting to pre-COVID as far as luxury is concerned. And for Orange County, inventory is at 775. It's up 70% compared to last year. Demand is at 135, down pending sales. That's down 44% compared to last year. And the expected market time is at 172 versus 57 days last year. Now, anything below 60, I actually consider hot, a hot seller's market. And luxury, I've never seen prior to the last couple of years, luxury actually in a hot seller's market. It's just absolutely unfathomably not normal. And prior to COVID in 2019, the middle of 2019, the expected market time for Orange County above $2 million was 370 days. Much different than 172. So you can see that, yes, we were at 57 We're at 172 today, but it was at 370 towards the end of the year. This is a cool time of the year for luxury. And Riverside County, the inventory is up 102%. That's 1,548. And demand is at 234, down 49%. And the expected market time right now is at 198. It was at 50 days last year at this time. Pre-COVID, it was at 398. So you get it. So yeah, it was at 50. It's at 198 today, but it was at 398 prior to COVID. And then San Bernardino County, inventory 734, that's 84% more. And demand is at 114, 35% less. And the expected market time went from 68 last year to 193 this year, but it was at 347 back in the middle of November 2019. And in San Diego County, that's 1,500,000 plus. Both San Bernardino and Riverside are 800,000 plus, but San Diego County 1,500,000 plus. Inventory of 930 homes above 1.5 million right now. It's up 78% compared to last year. Demand is at 206. That's 33% less. The expected market time right now is still relatively hot in San Diego at 135, but they were at 51 last year, 135 right now, and slowing. And prior to COVID in 2019 was at 235 days. So you get the point. Yes, it's cooler, but it's not where we were even before COVID. So it's actually a pretty decent market. And it actually beats overall housing markets because this is luxury. And you could see it was way up here at the beginning of the spring and during spring. And that's normal, though, that we should have a really hot spring. To actually start to see probably the highest numbers in June, but we had interest rates going up and we had the volatility of Wall Street. But you could see how there is definitely a progression way down that is not a normal progression for a year as far as how much it went down. As a matter of fact, in 2019, those are those purple bars. The average of that is probably at the bottom of that, the black arrow. But you can see that it's kind of like the market for luxury has slowed and it's making its way towards pre-COVID. But even at pre-COVID, that's still a lot of sales. So it's just going back towards a more normal market that luxury is not used to. And they're used to this quick, easy turn and burn type of thing. But that is not what how luxury typically behaves. And luxury is slowly but surely moving more towards a typical market. I have a feeling that by the time we get to the middle of next year, that it will be looking at a much more atypical luxury market where it takes on average about 6 months to sell to sell listings on average. Some sell quickly, but some it takes a year or even longer to sell. So Southern California closed sales, this is all closed sales combined for all of SoCal. And you can see that orange line, though, that this year, it also has been trailing down. Now, it typically trails down right now, but it trails down from June and July are typical heights. But you can see where this is 2019, that was prior to COVID, that was the average closed sales way up there. So we are definitely moving below average as far as closed sales are concerned. And you can see where that orange bar is for closed sales. I go back a couple, you can see the orange bar, which I'm pointing to right there at the end of that black line, how it has definitely come down. And the red bar next to it is last year. The green bar was 2020, and that is because 2020 we had a late spring and it was really hot. The purple bar right before that is 2019. So 2019 was higher than where we are right now. So but it's time to catch up. This is where luxury is catching up to the rest of the market. The rest of the market has really slowed down quite a bit. Luxury is slowly but surely making their way there, and I think they're going to fully get there by the time we get to mid next year. That's why I've been telling people, if you've got a luxury listing, place it on the first 6 months. That's pretty much where you need to be. As far as housing inventory is concerned, the number of available homes last Thursday was at 30,385. It went down 2%. In that period of time. So it went down a little bit. It was the first time it had been going down since September. It was the largest drop. Last year we were at 17,770. That's 42% less. But 3-year average is at 40,110, which is about 10,000 higher, 32% more. And today actually went from 30,385 to 30,007, down another 1%. So it really is another 10,000 homes from where we are today as pre-COVID. And what's going on right now? We're in the holidays. Holidays are right now. We have a boy right now that's flying. He's in the airplane coming from Washington State University, coming back over here for Thanksgiving, and the holidays are beginning. Thanksgiving is less than a week away. And as a result, that's when supply plunges, because there are fewest number of homes come on the market, especially the second half of November, because the fewest homes for any month is December, second fewest is November. And so supply plunges, demand plunges as well. We are going to see this big drop in demand. There's just going to be fewer homes available. As a matter of fact, there's going to be a lot of sellers that are going to want to enjoy the holidays that have not been successful. They're going to throw in the towel. And the number of available listings is definitely going to drop off by the time we get to the end of the year. As far as demand is concerned, this is a snapshot of the last 30 days worth of new pending activity. And I drew a line across for you, and there's only two other times where it was less. These two other times are, the one on the right is when we first went into COVID. Actually, prior to COVID, it was starting out to be an incredibly hot year in 2020. And then COVID hit, and yes, demand dropped. But then that was that V-shaped recovery. Now, the other one is actually the 2018, start of 2019, when we hit 5% interest rates. That too was lower than where we are today. And demand last Thursday, November 10th, 8,933, down 5% compared to where compared to the 2 weeks prior. Last year, we were at 17,301, which is almost double, 94% higher. The 3-year average is 14,176, 59% higher. That's about where the purple line is. But today, it's actually at 9,082 and went up 2% from last Thursday. This has everything to do with new escrow activity, and this is a result of interest rates coming down that 6%, or actually went down, 6% of a savings in one day. It was the biggest drop in the Mortgage News Daily since they started tracking around 2012, I believe. So a long time ago. They've been tracking this on a daily basis, and last Thursday, after CPI came out, it was the biggest one-day drop. So that just tells you we have that kind of big one-day drop, and it's been flat since then, which has allowed more buyers to enter into the marketplace and actually to pull the trigger, and that's exactly what happened. You see it's slight, but usually at this time of the year, what's happening? It's demand's going down, and then it really plunges because we're going into the holidays. Fewer homes available. We're going to the holidays. People are going to celebrate and have some fun. And that's what happens at the end of every year. So what's the speed of the market? Gobble, gobble. Well, last week we were at 102 days. We breached 100 days. It was up 3 days in a 2-week period of time. And last year we were at 31 days at this time period. Anything below 40 was insane. We were there for 2 years. I had never seen it before, other than some markets for about a month in 2013, not for 2 years. And the 3-year average is 86 days. So we're a little bit above that 3-year average. But today, because we actually had the inventory drop and demand go up, the expected market time got a little hotter than last week. So it's up 3 days, and it's down 3 days. So where is it going from here? It's actually going flat because we're not getting a lot of movement in interest rates. So it will be flat for the rest of the year. We're going to have demand and inventory dropping at the same rate just about. And that means that the market is not cooling anymore from where it's at right now. So I just want to wish everybody a very, very wonderful Thanksgiving. I hope you have a fabulous Thanksgiving celebration. We're all headed to my father and mother-in-law's pizza place. It's closed down. We play hockey in the parking lot. We don't eat pizza. We all bring our own linens, and there's about 100 people that will show up. It'll be so good. It'll be so fun. We could have all you want arcade games and a lot of festivities, good times. And probably the most special thing that we do is a prayer. We all go down around and say something we're thankful for. And I'm a sippy sappy guy, so I will lose it during that time period because it is such a great day. I love Thanksgiving. If you want a copy of this, please go to reportsonhousing.com. You will automatically get a copy of this. click on the subscribe button. We send these out. We have reports that dot all over Southern California, still working in that Bay Area. Now that things will slow down, I will have more time to finish it. And the most recent one that came out Monday, and this is for the coastal market. San Maria Riverside, get theirs this coming up Monday, and it's reduce and net less. I will show you statistically that you will net less if you have to reduce your asking price by more than 1%. And if you have to reduce your asking price by more than 5%, look out, cook out, you are giving up a lot of money. As a matter of fact, just as an example, for Orange County, if you have to reduce it between 1% and 5%, you are losing $15,000. If you have to reduce it by 5% or more, you're actually giving away $25,000 on average. So get those homes priced right when you get out of the box. So thank you very much. Subscribe, $15 per month or $150 per year. First month is free if you sign up utilizing the coupon code Thanksgiving. So that's all I have for everybody. I really appreciate you. I hope you have a wonderful holiday week. Enjoy all the family. Enjoy everything that we can be thankful for. And you know what? I'm thankful for you, and I'm thankful for the opportunity to bring you this. Thankful for this technology. Thankful for my wife, who helps me out so much with these different these housing debriefs, and so much support and love. So love all you guys, and thankful for you. Enjoy your Thanksgiving.